Welcome to It's the Economy. It is an important day for the global economy. The Fed has delivered a supersized 50 bips rate cut, and you can see the celebration across Asian equity markets and even currency markets. The dollar is on the back foot versus quite a few currencies. And of course, equities both on the Nikkei, on India, on several markets are celebrating. What does this really mean for Asia? Does it give all the central banks a little more elbow room to cut rates so that they can stimulate their own economies, especially a beleaguered economy like China? Also, a growing economy like India, does it get more stimulus? For all these questions, I have with me perhaps one of the best observers of the Indian economy, Chetan Ahya, the chief Asia Economist at Morgan Stanley. Chetan, good morning, and thank you very much for sparing time on what must be a very busy morning for you as well.
Thank you for having me, Latha.
Well, for starters, this rate cut, what does this do to the Reserve Bank itself? We're already seeing food inflation dipping. Do you think it gives RBI an elbow room to cut?
Well, I think if the RBI goes by the framework that they have laid out, which is that they want to see 4% sustainable inflation on headline basis, at this point of time, we still think that RBI will not be able to cut rates, just not because of the Fed. It's got to be more focused on domestic growth and inflation fundamentals. Also, at the same time, what we are telling clients is that if inflation is at 4.5%, which is what our base case is, RBI could still cut if you get growth somewhere closer to 6%, i.e. that it dips meaningfully below what RBI believes to be the underlying potential growth. So I think at this point of time, since our base case forecast is that inflation will be going down to about 4.5% sustainably, and growth is going to be 7% this year, it gives little room for RBI to go ahead and cut rates immediately.
Okay. Isn't there a possibility that inflation undershoots even 4.5%? As it is, the Reserve Bank's second quarter forecast is 4.4%. Going by the July-August numbers, it looks like it will not be 4.4%. It will probably be 4% or less than that for the quarter. As well, you have a huge Chinese disinflation, you have crude falling, you have probably a La Nina monsoon. Do you think there is a good chance of undershooting and therefore an opportunity opens up for a cut?
Well, so I think this quarter, if you remember, even RBI was earlier expecting it to be below 4%. Now they've revised it, but we are still at around 4%. So September quarter, definitely inflation will go down to 4%, but that would not be something that RBI can say it's durably down to 4%. We expect, and I think the consensus also expects it to go back up to about 4.5% in the coming quarters after that quarter. So it will be difficult for, I think from that context, RBI to go ahead and cut rates. But if we are wrong and inflation does go down to 4% sustainably, I think that will definitely open up the room for RBI to cut rates. And even if RBI cuts rates, Latha, we are only talking about a 50 basis points of rate cut. So I don't think there is a lot that interest rates can do now to boost growth.
Okay, Chetan, let's discuss growth as well. What has not been discussed much is that the FOMC dot plot has brought down the GDP forecast a smidge from 2.1 to 2%. It has brought up the unemployment rate rather substantially from the earlier 4% in June to 4.4%. Is there a chance of global growth slowing and that impacting India?
So I think US is on a very strong footing right now. And to the extent to which what we think the Fed has done is try to cut the risk of causing further slowdown out of restrictive monetary policy, it does give us the confidence that the US will be seeing soft landing. And look, right now, the third quarter number, according to Atlanta Fed, is tracking at 3% Q-on-Q. Yes. And it would be nearly around 3% on a year-on-year basis. That's a very strong growth rate that the US is going through right now. And in that environment, the Fed is cutting rates. So we are of the view that the US growth will be around, as it decelerates, it will still be around 2%, which is a pretty healthy number. And that will mean that the global growth environment will remain stable. It's not great because Europe is not doing well, and China is also not doing well. But to the extent to which what we have as support from the US, that should still be maintained going forward.
Okay. More pointedly about the India story before I come to China. You all recently upped your forecast a bit. Where is that confidence stemming from? I mean, after all, we are seeing unemployment going up in the US and in India as well. If you look at the August numbers, both personal vehicles, PVs, and commercial vehicles, CVs, actually fell. It was only two-wheelers that did well. So why you... And even PMI manufacturing has peaked off. Those services is doing well. So where is this confidence of upping India's GDP forecast?
Well, so we were a little bit lower than RBI. So we were at 6.8%, and we raised that to 7%. The way we did the math is that, the 6.7% number that we got for the last quarter had some negative effects of the election-related impact on government spending. That was about 20 basis points of shortfall because of that. And agri output was also somewhat weaker, considering what's going on in terms of the area under coverage. We think the agri output could also go up. And so you'll get about a 40 basis points increase in growth rates from 6.7 to about 7.1 from the next quarter itself. And so that's what has made us lift our forecast. In terms of the drivers to growth, you are right. You're getting somewhat mixed signals as far as consumption is concerned. We got earlier the development where rural consumption was lagging. Now rural consumption is improving. So I think that's one big factor that is giving us the confidence that the growth recovery is broadening out. And at the same time, if you hear from our industrials analyst about the breadth of CapEx story, there is enough evidence that now private CapEx is also picking up. So we are seeing this broadening of recovery from urban consumption to rural consumption, and from public CapEx to private CapEx. And the best metric is, GST numbers. They continue to be pretty robust. If you adjust GST numbers by deflator, GDP deflator, which is running at around 3%, you get a similar number as far as real economic activity is concerned.
Okay. Take your point. The RBI is, after all, standing steadfast on its 7.2 number. We will know, of course, in October, when the monetary policy report comes, whether they're changing their mind. But Chetan, I'm going to ask you a couple of unfair questions on the economy, on Indian economy, because I know you don't speak these numbers, but even if you can give me a directional answer. Do you see rupee appreciation? What is the range your team is working with? And yields. Indian yields have tracked the US yields. So even if you think the Reserve Bank is not cutting, we're already at nearly 675 on the 10-year. What is your team telling you in terms of the terminal rate for the 10-year by end of the year or in the next 12 months?
So look, Latha, the framework is what I can share with you. So the framework for INR, what we are highlighting to investors is that if the dollar is weak, INR will underperform because, if you look at real effective exchange rate, it's at the upper end of the band that you would see from a 10-year mean perspective. And we think that in that sense, on a real effective exchange rate basis, rupee has appreciated a lot, and it's a bit on the firmer side. And if the dollar weakens, RBI will intervene and not let the rupee appreciate, just as what we are seeing right now. Actually, a lot of the other regional currencies appreciated a lot, but INR did not. So that would be the approach that we would follow. And if the dollar strengthens, then rupee will outperform because RBI will then correspondingly again intervene to ensure that the rupee doesn't see significant depreciation. So I think that's the framework that we are operating with. As far as rates outlook is concerned, I think that's predicated on our view. The strategists are pegging their view on our view on the policy rates. And that I mentioned, we are not expecting any policy rate cuts from the RBI.
Okay. Well, actually, today the Chinese currency has appreciated decently after the rate cut in the US. So coming to China, India has two worries. One is this massive Chinese disinflation or disinflationary force in global markets likely to ebb at all. I mean, they're selling steel below cost, according to Tata Steel, $50, $60 below their own cost. as will EVs, solar panels. Is this disinflation likely to ebb at all? And now with the Fed cutting rates, does China have the elbow room to stimulate its economy with a monetary or fiscal stimulus? And therefore, do we get good news out of the Chinese economy?
So I'll answer the first question first, and that will help us to answer the second question as well. As far as the deflation outlook is concerned, the approach that Chinese policymakers are taking is trying to defend their real GDP growth in the context of this massive slowdown in the property sector by putting in more investment in infrastructure and manufacturing. What they are thinking to themselves is that if you think from the long-term perspective of the country, you have to invest. So while they have a big downturn in demand because of property sector, they're trying to defend it with these two areas of investment. Now that is resulting into excess capacity creation and therefore a bigger deflation problem. And I just recently put out in a report that, when Japan had a similar dynamic weighing on its economy in 1990s, Japan accepted lower real GDP growth. So its growth went down from 5 to 6% to 1%. But what China is doing in terms of defending that real growth and still targeting around 5%, that's resulting into this problem of excess capacities. And therefore, we don't think that the deflation problem in China is going to end anytime soon. In fact, it looks like it's going to be worse than Japan in 1990s. And sorry, Latha, I forgot your second question.
Yeah, will they be able to stimulate because they have now, more elbow room because of the Fed cut? Will China cut?
Yeah, I think it will definitely help. So we are expecting them to take up some more rate cuts and cut reserve ratios, required reserve ratios, but that will be only a marginal help. I think the fundamental problem that China has is that of deflation. And for that, we are recommending that they need to support consumption growth with increase in social welfare spending. They will never do the direct transfers that the US did, but they can definitely increase social welfare spending and support consumption growth. But for that, you don't need really further cut in interest rates. It's just a fiscal policy decision that the government has to make.
Fair point, fair point. Just a last, final and a quick answer. Basically, Fed cut positive for Asia?
Sorry, question is?
Fed cut positive for Asia, is it?
It is. It is positive for Asia in the context in which the Fed is cutting rates. Of course, if growth is decelerating hard and Fed is cutting rates, that's not necessarily positive because then the downside from growth will overwhelm the upside from lower rates. But in the current context and with our base case view that the US will go through soft landing, this is definitely positive for Asia. Because remember, Latha, actually, not India necessarily, but all the other countries in the region, they have their inflation below central bank's target for a number of months now. And they've been holding it back only for the Fed policy response. And so now as the Fed has begun to cut rates, and that too decisively, that gives them the elbow room to cut interest rates and ensure that their growth does not have to be taking a bigger hit.
Okay. Take your points. Thank you very much, Chetan Ahya, for spending time on what must be a busy morning for you and parsing the impact of the Fed's rate cut on India and on Asia, particularly China. Thank you very much for joining us. So with that, it's curtains on Bazaar with the news that the mid-caps are deep in the red, but the bigger indexes are holding up. Let's see how the day pans out. Wrap up on Bazaar. Chartbusters coming up.